Welcome to the October 28th, 2024 Advance Report from McGowanGroup clients and NetWorthRadio.com listeners. First question, what is economic growth right now? Well, the Atlanta Fed issued some good news this week. They've got all the data from the third quarter. The official numbers haven't come out yet, but the Atlanta Fed is usually spot on because they gather the data every week. Here, they're saying real GDP running at 3.4%. To put that in context, well, the average GDP for 20 years is about 2.1%. So that's over 50% above normal. That's a pretty healthy economy. Yet, this week, what's going on with the Dow? I mean, the Dow descends, right, to 42,500. It's down about 2% for the week. S&P was just below break even for the week, but the correction corresponded to something. Now, let's take the year-to-date numbers, and then I'll show you what that corresponded to. Why the little sell-off this week? If you look at the Dow, it's up 12.8% for the year, 14.5% if you put the dividends in there. But so that's still a very strong year, about twice the average. But what happened this week? We've been showing you as the companies report, well, how much is profit growing versus last year. So here we had a decrease. There were some disappointments this week. One of the keys to happiness is low expectations, and expectations were too high. And a lot of the companies came in with disappointments. And so now earnings growth over last year, just 3.5%. Last quarter, it was 11%. So we'll see how that shakes out because you've got less than 200 of the 500 S&P companies reporting, but that was one of the reasons for this week's sell-off. It was a good week for Tesla, by the way. They were up 22%. So here we go. This is the reason that you want to subscribe. I am Spencer McGowan, your financial weatherman. We're going to cover the real story on gold. I'm also president, McGowanGroup Wealth Management, the team of 11, the team that cares. This is the team you want on your side. We serve affluent families right here from the Crescent in Dallas. You can go to NetWorthRadio.com or the McGowanGroup.com, and what you'll see there is the ability to contact us and set up a Zoom call, or better yet, come down for a tour and see the Texas Financial History Private Collection with financial lessons that you won't forget. All right, what's the real story on printed money, gold, the dollar? How does all that interact? And what's the real story on how those move together? We would assume that if the Fed prints a bunch of money, that gold is going to go way up. So remember some of the key dates as we go through the slides here, because that's not necessarily true. When the Fed prints a lot of money, it is the balance sheet. The way they do it, see, the only one that can actually create dollars is the Fed, not the Treasury. The Treasury just borrows money so Congress can go spend it, and then the Federal Reserve tries to keep things in check with inflation and the overspending, and so they adjust the balance sheet for that. The way they do it is they just create currency and they go buy bonds and they stick that on the balance sheet, right? So this is the amount of electronically printed currency pushed out into the system for liquidity. Back in 2007, GDP was about 14 trillion. Now we would say it's probably 24 trillion, just to put it in perspective. But the balance sheet's going way up over that, the Fed basket of electronically printed currency. Now, first, they hit the 2008 crisis. So they printed another $1 trillion. Now you're at $2 trillion. Then that was to bail out the banks and prevent a depression and infuse liquidity because the banks were rendered insolvent by the mortgage crisis. All right, now, by the time we get to 2011, they're up to $3 trillion. This is when those newsletter guys like Stansberry, it's the end of America and we're going to have high inflation. Well, sure enough, you know, gold began to run, and I'll show you what the result was from that in a second. But then they kept on from 2013, they went all the way up to $4 trillion. That's 4 times as much printed currency. Then they start to tighten. 2018 tightening cycle, they just let the bonds antimatter off the balance sheet, take the money and retire it out of the system. Well, 2020, pandemic. They go from 4 trillion to 7 trillion. Wow. But by 2021, everything's fine. The economy's growing again. But look at this. The government kept spending more money than they brought in, and the Fed was complicit, and so they print another $2 trillion. They get up to $9 trillion in electronically printed currency. GDP is not even double where it was back here, but they're 9 times as much money pumped into the system. Now they're tightening, right? Because inflation hit, what, 9% back here in 2022. Some would argue more. Well, they've been letting $100 billion a month just disappear out of the system, and that's the tightening. Now you're at 7 trillion. Remember the key dates here. 2020, right? The 2008 crisis. Here we go. All right, this is the dollar index. You would expect that if the Fed prints that much money, that the dollar would go way down. Back in the 70s, they created a trade-weighted basket. So this is dollar index against all other currencies weighted by how much trade they do or how big their economies are. Dollar index comes out at 100. At the peak, 164. That was in the early 80s. Then the dollar descends to a low of 70 back when all the banks were bankrupt in the 2008 crisis. Then, and you could see right here, 120. That was a bad time to go to Europe because your dollars didn't go as far as right here in 2008. In here, if you went to Europe, your credit card bill would shock you because the dollar was relatively low. Now we're 104. What is that? It's exactly where the dollar was relative to other currencies 50 years ago. So that's the real story on the dollar relative to other currencies. What about gold? Whoa, look at this. The gold bugs have a sugar high right now, $27.58 per troy ounce, a record price for gold. Wow. And we would say, okay, maybe that has something to do with inflation. Well, let's go back here. Inflation peaked in 1980. So did gold. It was 800. Wow. Okay. So inflation subsided, but gold proceeds to go from 800 to 250. That's 20 years. Prices doubled. That means gold, essentially, the buying power went from 800 to 125. That's over 20 years where the price of gold had nothing to do with inflation. Then they invented the low-cost ETF. Gold goes from 400 to 1900, right about the time Stansberry's saying we're going to have high inflation. It's going to be the end of America. What his newsletter actually said was buy dividend companies and pipelines like we do. But the way he marketed it, I would disagree with. Now, look at this. Gold goes all the way back to about 1,000, 1,100. From 1900. This is 10 years in the desert. No return, no cash flow, right? Inflation picks up, and finally gold takes off. So, price of gold is not directly correlated to how much money the Fed prints, nor is it directly correlated to inflation. In fact, if you take this longer period from 800 to 2700 and do the math on that, well, that is actually below inflation for that extended period from 1980. We'll call it the last 40 years. So it didn't even keep pace with inflation. All right, this is the history spot gold, just the 20-year mark, and you can see that's a long period with no dividends and interest. In fact, 12 years in the desert with essentially no return from this point. One of the reasons that happens when you get a big spike in gold like 1980 or like here, They have gold Tupperware parties. The jeweler comes, the ladies all get together, they drink rosé, they sell their husband's gold chains and medallions and stuff he never wears, and maybe grandma's jewelry because she's passed away. And they get a big pile of money tax-free with, a nice party with their friends, and they walk out with a pile of cash. So you'll have a huge supply of gold at some point that comes out of the woodwork. All right, we all heard about China. Now back here, everybody said, this is 2005, emerging markets were still kind of the rage after the 90s, and the first China ETF comes out. Wow, how is that done? Because there's over 1 billion of them, and it's going to be the market of the future. And sure enough, China's purchasing power parity grew to about what the U.S. is by that measure. GDP is still not there. But look, what happened to the investor? Beware the abacus. None of that money made it back to the investors in the United States. It's somewhere in China. Because here, what's happened? Wow, you're at the same price as 2006. That is 16 years in the desert. That is the real story of investing in China. All right, be sure to subscribe, like it if you like it, and McGowanGroup Wealth Management stands by to help you update your plan for 2025. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.